welcome to the Killik & Co podcast for the 23rd of September. Last week was an interesting week, particularly relating to the Fed's meeting, where they were highly expected to have begun the tapering process, the process whereby the current $85 billion of stimulus that they're providing to the markets every month was expected to have reduced maybe down to $65 or $70 billion. But they actually held off from tapering, citing the fact that the growth numbers and indeed the unemployment numbers, particularly of late, had been slightly softer than where the target was. But most interestingly, it was the fact that since they started the tapering conversation back in May, bond yields have risen. US 10-year bond yields had reached a peak of around 3%, and in effect that had done the tapering for them because they were nervous about the rise in yields running ahead of the market. So as I say, they have reined off from tapering over the course of September. The question mark now is, when do they begin tapering? October, a lot of the conversation is going to be around the debt ceiling negotiation, so possibly unlikely they want more disturbance in financial markets during October. So the sort of revised thinking is we may see an element of tapering towards the end of this year, maybe the December meeting. But this is all getting quite late in the day for Ben Bernanke's tenure as chairman of the Fed, expecting to hand over to a new candidate in 2014, and with thoughts that they hoped that unemployment would reach the target levels during mid-2014, and by that time tapering would have been reduced down to zero. It looks like the game has moved backwards, and as a result of that, we've seen some quite big movements in financial markets. So let's try and summarise a lot of that. First of all, a quick look at the diary for the week ahead. We've started with some Chinese flash manufacturing details from PMI. Those numbers actually looking quite strong and indicative of around 7.5% growth in China at the moment. We'll take a look at some of the commodity plays. We've also got German PMI data. The election result at the weekend pretty much running to form. There will be some conversations, of course, just to get the absolute majority by forming some sort of coalition with the main rival there in Germany, but I think the market generally sort of neutral to happy on the back of that result this week. Just to turn into the week, well, it's going to be slightly lighter in terms of the market impact macro data, really a focus back on some of the companies that are reporting this week. The ones in black, Compass Group, Nike, these are companies that we have a particular interest in, having been covered in some recent thematic notes. So let's just take a look at some of the movers from last week, and I want to start off with the way that the US 10-year moved, and as you can see there, that sort of surprise decision to reduce the taper has meant that the 10-year yield has shied away back down to around 2.73%, where we stand as I speak, down from around 3% at the moment. Now I do think this is going to be a chart that needs to be watched very closely from here, and whether it's going to fall further or indeed the underlying momentum is actually to the upside at the moment. It will be quite interesting if this yield starts moving back up towards 3% and that they haven't begun the tapering process. The reason being that actually if it is this that is causing some weakness in the economic strategy going forward, then there will be question marks over whether or not the Fed have slightly lost control of the bond markets and what impact that will have for future QE programs. So we need to watch that one, as I say, quite closely. The other impact, of course, was on the currencies. We saw weakness in the dollar. We're showing here the pound sterling versus the dollar. It's obviously showing the pound is proving to be quite strong, nudging back up above 160. 162 is the 2013 high, and we're getting very close to that particular target at the moment. So dollar weakness across the board. Also, as there we saw the euro creep back up above 135 again, just really quite close to that sort of year high, as I say, supported by some better PMI data that we're seeing out of Europe on this Monday morning, and of course that election result in Germany. Stocks have responded. The Dow Jones Industrial Average hit an all-time high during the course of the post press conference relating to Ben Bernanke's talk. It likes the fact that the stimulus programme is going to continue with its foot pretty firmly flat to the floor for the next few months, and that remains equity favourable for the time being. And as a result of that, we saw a nudge into new high territory for the Dow Jones. The FTSE 100. As a result, is also performing reasonably well, still lagging somewhat, and really just posting some of the charts that are causing the FTSE to hold or just underperform slightly. Rio Tinto, it's down around 20% year to date, but these commodity plays have come off their lows, and really whether or not we've got some further upward trend there will be a key determinant as whether the FTSE can play a little bit of catch up in the final fourth quarter to other markets that are clearly performing well at the moment, the Dow and of course the DAX. Also highlighting the oil sector, because as you can see from this chart of Royal Dutch Shell, we seem to have very much centred into a trading range with all of these big oil majors at the moment. Undoubtedly, when you look at the fundamentals on Royal Dutch Shell, you'll be attracted to the cash flow, to the yields, yielding just over 5% at the moment, but trading towards the low end of its trading range at the moment. We're just watching this oil sector as potentially a bounce at the bottom end of this range in the next few weeks. Want to just quickly mention the Nikkei in Japan. That chart is starting to move back towards the high levels that were achieved back in April of this year, April and May. October the 3rd and 4th, it's just a note for the diary next week that we will have potentially more monetary stimulus coming in Japan. Bank of Japan meets on, as I say, on that date, and equities are certainly coming close to their sort of previous peak of this year. So certainly not one to ignore at the moment is the momentum behind the Japanese market. I want to mention gold also. Gold did have a little spike up on the back of the talk of continued stimulus in the US market last week. It provided a pop in the price, but it is being sold into at the moment. It still feels like the trend is under a little bit of pressure in the gold market. Finally, just a quick talk about the banks. We have obviously a rights issue out of Barclays Bank at the moment, and of course we had the placing in Lloyds that was seen last week. And both of these capital raising exercise, one obviously in the primary market, one in the secondary market, has seemed to have put a bit of a cap on the banking sector for the time being. So a little bit of equity to work its way through.